Okay, in this tutorial, I'll be teaching you a new stock, which is Fizz, and let's start with it. I'll just copy that. Sorry, I'll copy that and paste it in Google and write stock besides. And I know the sector is consumer, so it's national beverage. That's the name. Okay, and if I want to know what I need to pay right now to buy one stock of it, it's 44.63 US dollars. So I just pasted that in Google. This information on the left is from Google, and on the right is from Wikipedia. And I'll just copy that and I can just add it here, and it's in US dollars. That's the currency. And the boom, or when was it founded, I can just have a look from Wikipedia. I can click here and I can see founded. It says in 1985. I'll just copy that and I can paste it, and I'll explain it the sector later on in the video. Now I'll just look at four ratios that I'm very interested in, and the website I use for ratios is Macrotrend, and that's Macrotrend. And I'll go to price ratio, then I'll go to Pricebook ratio, and I'll type in the symbol or the name of the firm. So I'll just try the symbol first, and it's National Beverage. So you have to make sure that it's the name of the firm is written beside the symbol, because sometimes two firms have the same symbol. So I'll just click that, and I'm looking at price book ratio right now. And if I see in 2019, 28th of June, you can see the date at the bottom, it's 6.28. This means that the price, if somebody buys a stock right now for National Beverage, they will be paying 6.28 times more than what the book value price is. So it's 6.28 times more expensive to buy this stock compared to its real value. And if they bought it in 2019 January, it would have been 12 times or nearly 13 times more expensive. So right now it's cheaper than, it's like nearly half the price, half times cheaper than buying in January 2019. And it was the most expensive to buy in 2017 July. It was very expensive. It was 21 times more than its book value, which is not really good, very expensive. And the least was I just click all. The least was, I think, in 2008 or maybe 2006 January, when it was the price was 1.78 times more than the book value. It's still expensive. It's not exactly the same as the book value, but it's the cheapest. So people who bought that time got the stock very cheap. But the people who will be buying now, they will be buying six times, nearly 6.5 times more than the book value. But still, it's cheaper than people who bought in 2017 July. They paid 21 times higher price than they should have paid. So I'll just go to other ratios, and I'm interested in current ratio. If current ratio is 1.5 or more than that, then it means that there's good margin of safety. If it's less than 1.5, then there is risk in there's less margin of safety when investing. So I'll just have a look. Right now it's 3.31, which is way above 1.5. Then it's 1.93 if I go back, which is still above 1.5. And if I just go back and see the consistency, and I can just have a look. So from so just once, I think, um, in 2011, um, 2011 April, it was 1.41. It's a little bit less than 1.5, so which is not very good, but still it's safe. But in 2011 January, it was 1.12, which is very low compared. Like where there's very little margin of safety, because if you see the current liabilities is 0.17 and assets are 0.19 billion, so there's very less difference between current assets and liabilities. So but if I go back, there's consistency of being bigger than, higher than 1.5 all the time, except just one time, which could be ignored because that's just one time in 2011, just for 3 months. And the rest, like the history and the rest, is above 1.5, so which is good. So I can just ignore that period. 3 months is nothing. if I look at the trail, and right now it's 3.31, which is way above it's very secure. If I go to debt equity ratio, debt equity ratio should be zero point 0.5 or lower than that for it to be having a good safety. Right now it's 0, which means there's no debt, so it's operating all on equity, which is very good. So if I just go back, and in 2000 and before 2012 it's 0 as well, but from 2012 October, um, it no 2013 January, it got long-term debt, and it was more than the equity, which is scary because it's not good. It should be zero point 0.5 ratio, but it's 1.03. It's way above. It's above the so it's not ideal, safe. But then gradually it reduced, and in 2013 um, October, it came back to 0.43, so it's below zero point 0.5, which is ideal, and now it's 0. So maybe once off I might ignore for a few months again here, because the previous history and the current is very good, because it stayed above zero point 0.5 for a very short period of time, which is not very bad. So you need to be careful about that. Then I'll go to return on equity, which means what it's getting when its shareholders are investing. What's the return? It should be at least 8% for it to be ideal, or more, not less than that, for it to have a good margin of safety. Right now it's 39%, and if I just go back, and it's more than 8%, it's more than 8%, and throughout it has been more than 8% since 2006, since 2005, since we have the data. So it's like more than 8%, which is a very good return. So it's giving good returns. Now let me have a look at again. Let me see if it pays, if this firm pays dividend, because that's a good sign. I'll just have a look in Google. I'll just type that in again in Google, and I can't see dividend yield, so it means it might not be paying dividend, which means that which is not very good sign, because it means that it doesn't generate extra money to pay the dividends. So its financial might be all right, because it's not doing too good to pay the dividends. It doesn't have that much cash, maybe. So that's not there. And I want to know if it's a big cap or a small cap company. It's a market cap company. It's 2.08 billion, which is a big company. Then I want to know if it has any patents. So what I'll do is I'll just copy exactly from here, and I'll go to Justia Patents, which is a very good website to go. And I'll search on the search bar, and I'll just search that to see if it has any patents. I'm just interested in assignee or applicant, or this one is applicant, because assignee or applicants has the full right of the patent. Not interested in the inventor, because that's the person who invented, but they don't have the full rights of the patent. So this one is not the company. Okay. I'm looking at, okay, there's only one patent that I can see, National Beverage Corp, the assignee. It's in 1999. So since 1999, it doesn't have any patent on this website for this company. It just have one patent. So this is something to think about, because it was formed in 1985, and just 1999 it has one patent after 14 years, and then it doesn't have any patent. So it's not innovating right now, because it doesn't have any recent patents. So since like nearly 20 years it doesn't have any patent. So this could be a bad sign, because patents allow companies give a moat or a competitive edge. It acts as a competitive edge, which um, for this firm there's no competitive edge recently. So 1999 is like 20 years ago. So what it is doing right now, that's a question. So we need to be careful about that. Then I'll go to finance, Yahoo Finance again. In Yahoo Finance, if I just click there, and I just search on the search bar, and I click enter, National Beverage Fizz, that's the one. I need to go to profile, and I can have a look. I was telling you about the sector. You can just see the sector from Yahoo Finance in consumer defensive. That's the sector. and that's the industry: beverage, soft drinks, full-time employees, and other things. What I'm more interested is in key executives, so I need to know the key executives and their salaries, if their salaries have been shown. But here I see, because there's more transparency if the salaries are shown, so I can see only the chairman's salary is not shown, but the other salaries are shown. So I need to know why that's not shown. That's a question. And then, so it should be as transparent as much as it can. And the other two ones are shown. So there are some things to think about this talk. And lastly, I will go to Indeed and read regarding this company and see Indeed and Glassdoor. I just want to see that if what employees think about it. So that's interesting. I just click there and I see 3.1 reviews, but there's only 14 reviews. 14 reviews is not much to tell a true story, maybe. So, I'll be looking at maybe 100 reviews or more than that at least. So, I don't know if I need to trust or not, but you can still read through it. And then I can just see through Glassdoor, and I can, that reviews is really good as well. And Glassdoor, okay, I'll just click on that. And sorry, my computer is a bit slow. And then I can just see 34 reviews, which is better than in Indeed, and it's 2.66 stars. So it means maybe the employees are not very happy with this firm, working in this firm, because when they're working inside, they tell this true story. So you can just have a look and have a read through it.